Hey everyone, it's Mark Ferguson with Invest for More, and today I'm talking about the inflation numbers that just came out, which impact all of us if you're in real estate or not, because those impact interest rates, which impact all of us. And I think it's very important to know what inflation's doing, what the Fed is doing, and how that might impact the economy, housing, and all kinds of different things. So, I want to talk about inflation and a lot of misconceptions out there as well. A lot of people think lower inflation means prices will go down, which it does not mean that at all. A lot of people think higher rates mean housing prices will go down, which it doesn't mean that either and has not been happening. But in general, most of us should want lower inflation because it should make our lives easier because rates will be lower, which makes all of our lives easier. So we'll talk about a lot of that. We'll show the numbers and talk about what might be happening in the future because of these numbers as well. Now, most of my videos are walkthroughs of my properties, my commercial properties, my residential properties, multifamily, and the businesses I own, the liquor store, mini mart, and of course the new laundromat that I just bought. And I do like to talk about the numbers and economics on some of this stuff too, because it impacts all of those businesses and properties as well. All right, so inflation right now is 3%, which means prices are 3% higher this year than last year, at least the prices that are tracked by inflation. So a lot of people say the inflation numbers are fake, they don't track the right numbers, they're manipulated, and they could be, I'm not gonna lie, but we still can look at trends, and the trends are what's important, and that's what the Fed looks at too. So when we talk about the Fed, we're talking about the Federal Reserve Bank, which sets interest rates, which impact mortgage rates, car loan rates, and all kinds of different things. So right now, the inflation rate is 3%, which means, if I get out my trusty calculator here, if you bought something for $100 last year, then it's 3% higher this year. It would be $3 more, or $103 this year. Now, of course, every product moves in different trends and different amounts, but overall, for what inflation tracks right now, that's how much prices went up. So one thing I want to talk about, one big misconception out there is that when inflation lowers or the rate drops, that prices go down. And so I posted this on my Instagram, Facebook, and a lot of people, almost get angry at me. They're like, inflation's not down, prices are still higher, it's so much more expensive to do things. Yes, that is true. Prices are still higher. What a lower inflation rate means is that they're not going up as fast. Instead of going up like this, they're going up like this. So prices are still going up, they're just not going up as fast. So the only time prices decrease is when you have deflation, which is extremely rare. It has happened. It happened in the 2008 crash, but it's very rare that prices will go down. So you have to get used to the higher prices. What we're concerned about and what the Fed is looking at is if prices are still going up significantly or if they're going up just a little bit. And that's what determines if they raise interest rates or keep them the same or lower them. So if we look at this chart right here, I'm on Trading Economics, which is a great site for lots of different data. Last year in July, inflation was 8.5%. So that means, if you bought something for $100 a year ago and inflation is 8.5%, you'd be paying $108.50 for it this year. So inflation is much lower. The Fed likes to say they want to keep inflation around 2%. That's their goal. However, 2 to 3% is kind of historically where it has been. So we are very close to historic inflation rates right now. And something else to think about too is a lot of people think, well, inflation has dropped from 8 to 8.5. It dropped from 4 last month to 3 this month. Inflation must have really dropped this last month. That's not really what happened. What happened is, and I'll show you here, they've got this neat little chart here, month over month inflation. This shows us the inflation rate for each month. Well, in June of 2022, inflation was over 1%. So you can see the highest rate in the last year has been 0.5%. So June was up here in this hose outlet thing, whatever that is. I'm not sure. But anyway, it was way up here. So almost all the high inflation we've had the last couple of years has been in 2021 and the start of 2022. And so the reason we've seen inflation drop so much and drop from 4% to 3% is June dropped off the year over year numbers. So once that month got passed up, we have a much lower inflation rate. So for the last year, we have had pretty steady, pretty normal inflation for almost the entire year. It's not like inflation just dropped recently or just dropped in the last few months. It's been for an entire year of pretty steady, relatively low inflation. It's just that the 2022 inflation in June, May, April was very, very high, and that was causing our year over year to still be very high. Okay, and this chart is 25 years back, and you can kind of see how inflation has really stayed. Hold on, this is month over month still. This is easier if we do just year over year and do this. It's easier to see. Okay, there we go. So this is 25 years, and you can see inflation was up close to 4, then it's dropped down below 2, up a little bit, up above 4 again, dropped down, up above almost to 6. This is the deflation period I was talking about in 2008 with the crash, back up to 2, up to 4. So it's bounced around a lot, and we never heard about it being too crazy or freaking out about it until recently. In 2020, the Fed Reserve Chairman Jerome Powell actually said inflation was too low and we need to increase it. Well, he got his wish, that's for sure. And then you can see it jumped up quite a bit to almost 9. I can't remember if it might have hit 9 for a brief period. And this dropped all the way back down. And the federal government has been very confusing about this because, like I said, Powell said inflation was too low in 2020. Then 2021 came along and inflation was rising. He said it's all transitionary. It's from supply chain issues. It's going to go away, don't worry. And so inflation kept going up. And then they freaked out. Like, oh my God, inflation's too high. We have to raise rates the fastest we've ever raised them ever. We have to get this under control. It's not right. And just, 6 months ago, they said everything was okay, is just transitionary. So they really just tend to overreact like crazy. And what's also frustrating is when you raise rates, lower rates, even Powell and the Federal Reserve will say it might take 1 to 2 years to actually see the effects of that. And yet they just keep raising them like crazy because rates weren't, or inflation wasn't immediately dropping. And then it did drop. As you can see, it's dropped significantly, pretty much back to where the normal levels were. And they're still saying it's too high. We can't rush back to low rates. We can't do this. We have to make sure we keep inflation down. When 2 years ago, they're saying it was too low. So that can be frustrating. But historically, you can see we're slightly above where we've been the last 10 years. But before that, we're right in line with where inflation has been, and they weren't freaking out back then. They raised rates and lowered them, but they didn't go crazy raising them the fastest in history and leaving them there like they want to right now. Okay, so why should people want lower inflation? So I talked about this a little bit. I've mentioned how I mentioned inflation is lower, and people tell me, no, it's not. Prices are so much higher. In 2018, I could buy this for this, and now it's twice as much. And yes, I'm not denying things are more expensive. They're definitely more expensive now, but most of that increase happened over a year ago or 2 years ago. And because of those price increases, the federal government raised interest rates, which means house mortgages became 3 times more expensive. The rates became 3 times as high, not quite 3 times more for your payment, but the rates increased significantly. Car loans increased significantly. And not only that, but I know I'm kind of a detractor here and don't have a popular opinion with this. Higher rates make things more expensive. So a lot of people think I'm wrong when I say this, and that's okay. But higher rates are supposed to kill demand and therefore make less people buy stuff and therefore make prices drop, or not really drop, but start going up as high. I own a liquor store. I own a mini mart. As many of you know, I've owned it for a year and a half now. And if you kill the supply on my liquor store, I don't lower prices. If my sales drop, that means I'm making less money because there's less sales, less profit. Well, I have to pay my staff, utilities, rent, cost of goods, all of that. So if I were to all of a sudden say, I'm going to drop all my prices, I will be losing money and not making anything. And there's no reason for me to do that. I would be better off closing the store than dropping all my prices so much that I lose money. What you actually do, and this is kind of basic economics, we learned about this when I was in business finance school, is if you sell fewer goods, you raise your price. If you sell more goods, you lower your price. You make the same amount of money with high prices and low demand as you do with low prices and high demand. So this idea that people just automatically drop prices when supply is lower, I think is completely false. Maybe if you have a surplus, just a massive amount of goods sitting in a warehouse that you're not doing anything with, then you might lower your prices to get rid of them, but not if you're having to buy new goods, manufacture new goods. What companies do is if supply drops, they stop making as much of that good. They might have to lay off people, maybe they sell off some factories, and then they raise their prices because they know people will still buy them at those higher prices, just not as many. And the opposite happens if there's more supply, or more demand, sorry. If there's more demand, if there's more people who want to buy things at my liquor store, Mini Mart, I can sell them for cheaper because I have more sales coming in, I can have a lower profit margin and still make money. This is the Walmart model. Walmart sells stuff cheaper because they have so many stores and sell so much stuff. They've scaled to a point where they can lower their prices and still make money. And the thing a lot of people don't realize too is when you do that and you're selling so many goods, your suppliers will give you bulk deals. If I buy Coors Light and I buy 20 cases, they might give me a certain price. If I can buy a whole pallet, they'll drop that price significantly. And if I sell more of that good, not only am I making more money because my sales are up, but my costs are lower, which means I can even lower my price a little bit, have more people come in, sell more of that good. And if I sell more of that good, maybe my supplier will drop their price even more. I can lower. It's like a snowball where if you raise rates and things get more expensive, it's a snowball in the wrong direction where prices get higher. If you have more supply, more people buying, it's a snowball in the other direction where prices can actually get lower. Now, some people like to say, well, corporations are being greedy. They're just making profits, like huge profits. They're making all this money. That's why inflation is happening. And that possibly could happen in a very short term or if they're anticipating prices going up. But if businesses like mine are just making huge profits and all this money, ultimately what that does in the long run is that invites more competition. If there's all this money to be made in certain industries, that means more people are going to join those industries, more companies will be started, or competitors will be able to lower their prices and take more share away, and you can drive prices lower in the long run. Maybe in a very short term, they might be a little bit higher, but with more competition, more companies, more demand, prices tend to get lower and you have lower profit margins in the long run. Now, if you're making things more expensive by raising interest rates, because not only do interest rates make houses more expensive and cars more expensive because payments are higher, but almost every company like mine uses debt, which means their cost of goods gets higher, and that ultimately gets passed on to the consumer. And if that debt gets more expensive and they expect us to lower prices, then you have more and more companies actually closing and laying off people. And if more companies are closing, that decreases the competition, which means the companies that survive can raise their prices. So all in all, lower interest rates are usually better for most of us. And as far as housing goes, obviously it makes housing more affordable, makes cars more affordable, and in the long run, I think it makes goods more affordable. And some people will say, well, why has inflation gone down then? They raised rates, obviously it worked. Well, I actually think the Fed was right when they said inflation was transitionary and that supply chains caused most of those increases. I think that was 100% right. Seeing it in my remodeling industry, fixing up houses, lumber went crazy, appliances went crazy, all these plywood went crazy, all these goods shot up in price because they couldn't make enough of them. There weren't enough of them, there wasn't enough shipping, there wasn't enough delivery, it took so long to get them, and places could charge a lot of money for them. Well, if you make it easier to supply goods, to expand, to make those products, to bring manufacturing to the United States even, you will eliminate those supply chain issues. They'll make more goods and prices will naturally come down. And if lower rates are here, it's easier to expand and make more goods. If rates are higher, that makes it harder. Same thing for housing, which we'll talk about here in just a little bit. But before we get to that, for the normal person who thinks inflation is too high, prices have gone up. I'm not saying you're wrong, but you want inflation to be low because here's what Powell says about jobs and wages. From 2023 in February, throughout 2022, Federal Reserve Chair Jerome Powell emphasized that wage growth was too high, that as he said in November, nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. He didn't explain why, and nobody pushed him, given that wage growth was in fact much higher than it had been over the previous decades and what we'd expect given labor market tightness. And Powell has said this over and over again. What he's saying is that one reason that inflation has been higher is that wages are too high and the job market is too strong. So for the everyday person, you want higher wages. You want to be able to have a job or choices for jobs. And so if inflation is too high, right here, the federal government is saying they want to drive down the economy with higher rates to make your wages lower and make job opportunities fewer. So as an everyday person, you want inflation to be lower because hopefully they lower rates, go back to a more normal market, and we still have wage growth in jobs and all of that. Now, as far as housing goes, a lot of people think that high interest rates make house prices go down. Even Jerome Powell has said, we want to raise prices to calm the housing market. Well, it might calm it short term again, but long term it does the exact opposite. So in the 70s and 80s, here, we'll shorten our chart up right here. We had some of the highest inflation in the history of the U.S. There was still higher in the 40s. There was still higher in the 20s. But in recent memory, this was the highest inflation in the U.S. And what we saw, this is median house prices. Prices started around I should go back a little farther. Sorry about that. 23,000, 22,000 in 1970. By 1980, house prices were at 63,000. They'd almost tripled, while rates were going from 5 to 10%. It did not cool the housing market. In fact, it made it much worse. And interest rates peaked around 81, and you could still see, even with 18, 19% interest rates, housing prices kept going up. We saw a couple blips, just real short blips here in housing prices. Nothing significant. They just kept going up and up and up. And rates didn't get below 10% until the 1990s, when housing prices just kept going up. We saw another small blip. But historically, higher rates don't make housing prices go down. The fact is, there's so many factors that determine housing prices. The only crashes we've had were caused by massive overbuilding and horrible lending, not interest rates. And interest rates actually decrease the supply of housing, high interest rates. The higher interest rates go, the less building there is. If you have fewer building, that means you have more buyer demand for the houses that exist. So while you might have a short-term blip in housing demand and housing prices with high rates like we saw at the end of 2022, eventually, if there's not enough houses, prices are going to keep going up. And if you have high interest rates, they're not going to build enough houses, they're going to keep going up. So the longer we have high interest rates, the longer rates are higher, we're going to have fewer houses built. It's going to make the housing problem worse as far as affordability in the future. The sooner that rates stabilize or actually start to drop, the sooner they will build more houses, and that will actually help stabilize the housing market and keep it from going too crazy. Now, there might be a short-term craze in housing prices if rates drop significantly because there's so many buyers waiting to buy. But in the long run, it will actually be a good thing because it will encourage more building, which will stabilize things. And the longer you kick that can down the road and keep rates higher because we need to stabilize housing prices, the fewer houses that will be built, and the worse that problem will be when rates eventually come down. So in conclusion, I know a lot of people say inflation's high, it's crazy, prices are still high. And you're right, prices are still high. But inflation doesn't mean prices, or a lower inflation doesn't mean prices drop. It just means the rate of increase slows down. And you can see from our charts, it has slowed down significantly. Lower inflation is good for people. You want there to be lower inflation. You want there to be lower interest rates. It makes everything easier, everything work better. It means you'll have enough supply. It means houses get cheaper as far as rates go. Cars get cheaper. Debt gets cheaper for businesses, which means they can charge less for their goods. It means they can expand their supply chains, which means things get cheaper. It means maybe they can bring things from China to the US, which means there won't be supply chain issues in the future maybe. There's so many benefits to lower interest rates. It makes our economy work better. It makes the everyday person pay less for goods, and it should be thought of as a good and happy thing when inflation goes down. And yes, prices are still higher. There's no harm in complaining about that or saying things are higher or saying it's tough on the American people. It is. But at the same time, if we have our rate of inflation lowering and that causes interest rates to go down, that is a good thing for almost everyone. Okay, hopefully that helps and clears up some things. We'll see what the Fed does, because a lot of times the federal government has said things that don't always make sense to me. And they've continued to say inflation is way too high, even though for the last year we've seen the month-over-month rate has been actually very normal and where it has been historically. So maybe with this getting down to an actual 3% year over year, we'll say, hey, maybe we can slow down. We don't have to push things as hard. But again, I wouldn't count on that. All right, like I said, we'll have many more videos of my businesses, the laundromat, liquor store, my flips, rentals, all of that too coming up. And once in a while, we'll have these economic videos as well. All right, thanks for watching. Be back soon.